So this video is really important if you want to understand what on earth has just happened to gold. Why has it crashed so badly during a war? I've got a whole bunch of notes here. I'm not going to edit anything. I just want to get the knowledge out to people to help them understand, okay? So what I want to talk about is everyone thinks war breaks out, fear goes up, and gold must go up too. I have spoken about this before on my other videos, because it does sound so simple and it does sound logical, and most of the time that is partly true, but that's not the full story, and that's what I want to get into. Because during the current Iran war, gold got hit actually quite hard. So what happened precisely? Did gold suddenly stop being a safe haven? Is it all changed? No, it's not changed at all. What's actually happening is actually much more interesting. And once you understand this, you'll walk away from this video understanding gold a lot more. So I really recommend sticking around for this. So you got to understand something. Trading gold or investing in gold, it's not just a war trade, so to say. It's not just a fear trade, it's actually a macro trade. And that means that gold is reacting to a lot more than just the headline. Yes, gold can create a safe haven demand. That part is still true. But war can also create higher oil prices, which I'm pretty sure every single person watching this video is aware of. Higher inflation fears, higher bond yields, and a stronger US dollar. And of course, profit taking. And even physical delivery problems in the real world gold market can affect the gold prices as well, which I'll talk about later in the video. In this case, all these forces together ended up overwhelming the usual safe haven story. Gold has fallen sharply as the dollar and treasury yields rose on fears the war would keep oil prices high and inflation elevated, which could keep interest rates higher for longer. And that's the first big lesson right there. You see, you have to understand gold doesn't simply look at the world and say, oh, is the world scary? I'm going to go up. Gold also asks, what is happening to the dollar? What is happening to yields? What is happening to inflation? What is happening to liquidity? And this is why the move has confused so many people. See, they were watching the war. The market was also watching the consequences of the war. Let's break all this down just to make it a bit more obvious. The first thing the market saw was not just missiles and headlines. It also saw an energy shock. Well, we all saw the energy shock. Oil prices surged as the conflict disrupted the region, and that matters because when oil goes up sharply, markets start worrying about inflation. And when inflation worries rise, the central banks are less able to cut rates. In fact, it's been reported that by March 20, traders had sharply reduced expectations for rate cuts, while higher yields and tighter policy expectations were putting pressure on gold. That is incredibly important because gold pays no yield. I know I say this all the time, but you have to think about this from the perspective of a big institution. Gold paying no yield is really important because if you have billions of dollars you're managing, if you're a billionaire, for example, paying no yield is extremely important because those numbers will add up very, very quickly. So if the market suddenly thinks that cash and bonds are going to stay more attractive for longer, that actually hurts gold. In other words, gold likes fear, yes, but it also does not like rising competition from interest-bearing assets. Think of it like a tug of war. So even though the war created fear, it also created a macro environment that became hostile to gold. That is the second big lesson. War is not automatically bullish for gold, as some people think. It depends on what kind of war shock it is. If the war creates fear and also falling yields, gold can actually do very, very well. But if the war creates fear and rising oil and rising inflation and rising yields, then gold can actually struggle. Well, badly in the short term at least. And that is exactly what has made this whole thing so educational for people to understand, because it wasn't just a clean, simple buy gold panic. It was actually a messy macro shock. Now, let's talk about the US dollar, because that is another huge part of the story, as I hinted at earlier. Gold is priced in US dollars, and as I'm pretty sure literally everyone on this video would be aware of. And when the dollar strengthens, gold becomes more expensive for buyers who are using other currencies. So for example, if you have to change it into US dollars, it's more expensive, right? Now this can actually reduce demand and also weigh on the price, because the US dollar goes up, so gold looks more expensive. People have tied gold's decline directly to the dollar strength during this particular period, saying that the stronger dollar has made bullion less attractive while yields also rose at the same time. And this is where a lot of newer investors get tripped up if they're not aware of this. They think safe haven means only gold. The dollar is also a safe haven in many situations, which I think is the key thing people might have overlooked, to be honest, but at least now you know. It's always important to keep learning. So during a geopolitical crisis, you can get this tug of war, which I've sort of spoke about before. Gold can get some support from fear, yes, but the dollar also gets the support from fear. From the perspective, especially from big institutions. Always keep that in mind, of course. Not like the average small investor, retail investor goes, oh, I'm going to buy some dollars. Like, come on, you know what I'm saying. And if that fear comes with a higher oil and higher inflation and higher rates, and the dollar yields end up winning this tug of war. From looking into this quite a lot, it seems to be what's happening here. But now we get to the part that I think most people completely missed. And this is one of the smartest parts of the whole story, which I think you should really pay attention to. It's very important to know, and I think people who are bullion holders or gold stackers will be aware of this. This was not only a paper market move. This was not only hedge funds and futures traders pressing buttons on a screen. There was also a real disruption in the physical gold market due to the conflict. It's been reported that on March the 9th, that gold in Dubai was trading at a discount to London, roughly $10 to $30 per ounce, because the war had disrupted flights across the Middle East. Dubai is a major bullion hub, and those flight disruptions limited deliveries to places like Switzerland, India, and Hong Kong. On top of that, it's been said that demand was weak in India and the Middle East because buyers were holding back amid the uncertainty and volatility. Interesting, isn't it? Investor psychology. It's not just trading lines on a chart. If you're trading, it's people, humans with emotions. It affected the physical plumbing of the gold market. You got to think about that. The physical gold market was actually affected by the war, which obviously affected the price. Gold is not one giant magical market just floating in the sky, some monolith just by itself. No, it's actually a chain. It is the London spot, it is the futures markets, it is vaults, it is refiners, it is dealers, it is planes, it is shipping routes, it is wholesale hubs like Dubai. And when those connections get damaged, prices can temporarily behave in ways that make no sense if you're only staring at the chart. I think a lot of traders get very focused on technical analysis and what's going on in the charts, which is important, but it's also important to understand what's going on in the world, obviously. And this is why the story is so valuable for anyone watching the video, because the lesson isn't just, well, gold went down, I guess, oh well. The lesson is that there's no single gold market. I'll say that again, there's no single gold market, which I've spoken about a little bit in other videos. There are paper markets, there's physical markets, there are benchmark prices, there's even local prices. And during stress, those prices can actually diverge. So in this case, some golf dealers were effectively stuck with metal they could not move easily. And when the local demand was also soft, discounts started appearing. That is not the kind of thing most people think about when they hear gold, but it matters quite a lot. There's another piece that made the sell-off even worse. Profit taking. See, gold had already had a huge run before this latest drop. So when the macro backdrop turned less friendly, some traders simply locked in gains. The sell-off matters because not every sell-off actually means that investors hate gold, just to make that clear. Sometimes it means they actually loved gold and they made money, which is also great, and then they saw a reason to take some of that money off the table, which is logical to do if you're a professional or anyone making money. Not financial advice, of course. That is a very different story to what some people might think. And there is another nuance that makes this even more interesting. This doesn't look like a clean, well, everyone abandoned gold story, because gold, physically backed ETFs, actually saw another month of inflows in February 2026, adding $5.3 billion US, making it the 9th straight month of inflows. That is fascinating, because it suggests the weakness was not simply about investors giving up on gold altogether. It looks more like a short-term squeeze caused by macro pressure, stronger yields, complicated dollar move, profit-taking, weak regional demand, and physical bottlenecks in the Gulf. Now let me give you the deeper framework, because this is the part I really, really want people to remember. Gold is not a war meter, okay? It's not a war meter. It's a macro stress meter, okay? There's a difference. Sometimes war helps gold, of course, because it creates fear and it drives safe haven demand, but sometimes war can create an oil shock, especially if it happens in an area like the Middle East. That oil shock causes inflation fears, and those inflation fears push yields up. And higher yields therefore strengthen the case for cash and bonds, if you're a big institution particularly, of course, as I always say. The dollar gets support, buyers in some physical markets step back as a result, logistics get disrupted, dealers start offering discounts in places like Dubai, and suddenly gold is not acting like the average person expected at all. Not because gold's necessarily broken, but because the average person was using a very simplified version of how gold works. And I really hope this video has kind of in detail explained that a bit more for someone. And that is really the whole point of the video, to be honest. Gold didn't fail during the Iran war. The simplistic gold narrative failed. The headline only understanding failed, because markets do not price just the event. They price the consequences of the event, you see. And in this case, the market was pricing higher oil, stickier inflation, higher yields, a stronger dollar, physical dislocations, weak local buying in key regional markets, and traders taking profits after a massive rally, which we saw particularly into that 2025. So next time someone tells you war means gold must go up, remember, you can say this: gold is much more complicated than that. Gold is reacting to fear. It is also reacting to rates, currencies, liquidity, positioning, and the real world machinery of a bullion market. Thank you very much for watching. I'll see you in the next one.